Welcome back to my channel, Think CSEC. Today we'll be doing the CSEC Principles of Business, January 2020, past paper 1. But please pause this video if you're new to the channel and go right ahead and hit the subscribe button and turn on your notification bell so that you are alerted when new videos are posted. So let us get right into this paper. The first question says, which of the following financial statements shows the value of a business assets? A. Balance sheet. B. Trading account. C. Cash flow statement. Or D. Profit and loss account. Well, we know once it's a financial statement, we know it is the balance sheet. So our answer is A. Is our answer. Let's go on to question number 2. It says, the main internal users of accounting information are A. Managers, B. Competitors, C. Local communities, or D. Government agencies. We know once it says the main internal users, we know it is A. Managers. Let's go on to number 3. It says, which of the following features are benefits of using accounting software? 1. Integrated analysis of information. 2. Almost immediate updating of records. 3. Programmable to recognize irregular entries. Our answer options, is it A, 1 and 2 only, B, 1 and 3 only, C, 2 and 3 only, or D, 1, 2 and 3? We know it is all of the above, 1, 2 and 3. So our answer is D. Let's move on to number 4. It says, which of the following list of activities shows the correct order of the stages in the accounting cycle before final accounts? A. Posting to ledger, journalizing, then or trial balance. B. Is it first posting to ledger, then trial balance, then journalizing? C. Journalizing, then posting to ledger, then trial balance. Or D. Journalizing, trial balance, and then posting to ledger. We know our answer is C. First, journalizing, then post it to the ledger, and then to the trial balance. Let's go on to number 5. Here it says, the following information refers to the assets and liabilities of Mr. Jones. Cash at bank, 800, inventory 400, payables 600, receivables 125, bank overdraft 250, cash in hand 500. From the information above, Mr. Jones' capital amount is A. 405, B. $450, C. $850, or D. $975. Now, we know in order to find our capital, we know that it is assets take away from our liabilities. So, what are our assets? Our assets are cash at bank, $800, inventory, $400, receivables, $125, and our cash in hand, which is $500. So now when you add all of that total, you should get 1,825. What are our liabilities? Our liabilities are payables, $600, and our bank overdraft, which is $250. So that in total is $850. So as we said, capital is assets minus liabilities. So $1,825 take away from $850, we're left with $975. So our answer is D. Move on to number 6. Partnerships are formed for the let me read that again. Partnerships are formed for the purpose of 1, combining capital from different persons, 2, benefiting from different skills and specializations, 3, sharing ideas, experience, and responsibilities. Our answer options are A, 1 and 2 only, B, 1 and 3 only, C, 2 and 3 only, or D, 1, 2, and 3. So we know that partnerships are formed, 1, combining capital from different persons, yes, benefiting from different skills and specializing, and 3, sharing ideas, experience, and responsibilities. So our answer is D, all of them, 1, 2, and 3. Let's move on to number 7. It says, which of the following is usually used to complete a general journal entry? A, narration, B, description of assets, C, description of liabilities, or D, name of book to which entry must be posted. We know this is an easy one. It is A, narration. Let's go on to number 8. Here it says, item 8 refers to the following balances at the end of a financial period. Motor vehicles, $2,000. Payables, $3,000. Receivables, $2,000. Capital, $11,000. And building, $10,000. What is the total amount for the assets? A, $12,000. B, $13,000. C, $14,000. Or D, $15,000. Well, we know what is our assets. We have motor vehicles, $2,000. We have receivables, $2,000. And our building, which is $10,000. So when we add all of that together, we get $14,000. So that is our answer. So our answer is C. C, $14,000. Let's go on to number 9. Ram Singh purchased goods valued at $500 on credit. He paid off his bill within the grace period and so received a 10% cash discount. How much did he pay for the goods? A, $50, B, $450, C, $490, or D, $550. So when we find 10% of $500, we get $50. And then we have to find the discount, we have to take away $50 from $500. So therefore, we're left with $450. So our answer is B. Let's go on to number 10. It says, which of the following items are examples of current liabilities? 1, mortgages. 2, accounts payable. 3, accrued wages. Is it A, 1 and 2 only, B, 1 and 3 only, C, 2 and 3 only, or D, 1, 2, and 3? Well, we know what are current liabilities. Current liabilities are amounts that are due, which will be paid within a year of the balance sheet date. So now, within that financial period. So, what would be our current liabilities? We know it would be mortgages is not a current liability, but we know that accounts payable and accrued wages are current liabilities. So, therefore, our answer would be C. Let's go on to number 11. It says, which of the following entries in a three-column cash book are contra entries? A. Debit cash, credit bank. B. Debit cash, credit cash. C. Credit cash, credit bank. D. Debit bank, credit bank. We know it would be, once it's a cash book, we know we would debit the cash and credit bank. So our answer is a three-column cash book. Let's go on to number 12. It says item 12 refers to the following balances taken from the books of Sheridas Limited on 30th of April 2019. Here we have our balances. Rent owing, we have $200. Cash, we have $3,500. Payables, we have $1,200. And prepaid insurance, we have $300. And bank overdraft, we have $400. The question says, what is the current ratio? What is the current ratio of Sheridas Limited? A, 1 to 1. B, 1.5 to 1. C, 2.1 to 1. D, 3.1 to 1. So, how would we arrive at this answer? Well, we know how do we find our current ratio. We know that our current ratio is equal to current assets divided by current liabilities. So that is how we find our current ratio. So now, what is our total current assets? We have cash, $3,500. We have prepaid insurance, $300. So that is our current assets. Now that in total, 3,500 plus 300, we get 3,800. What are our current liabilities? Now our current liabilities, rent owing, $200. Payables, $1,200. And bank overdraft, $400. When we add all of that together, we get $1,800. So our current assets is $3,800, and we divide that by our current liabilities, $1,800. Therefore, our answer is C. When we divide that through, we get 2.1 to 1. So our answer is C. Let's move on to number 13. It says, which of the following entries should be used to post sales returns? A. Debit sales returns account, credit the receivable account. B. Debit sales returns account, credit sales account. C. Debit sales account, credit sales returns account. D. Debit the receivable account, credit sales returns account. We know it is we debit, or answer is A. We debit sales returns account and credit the receivable account. Let's go on to number 14. Which of the following persons monitor a company's financial statements to discover a desirable rate of return on capital? A. Investors. B. Suppliers. C. Customers. D. Employees. We know it is our investors. So our answer is A. Let's move on to 15. Here it says, item 15 refers to the following information from the books of a company. Cash sales, $10,000. Credit sales, $45,000. Inventory on hand, $40,000. Drawings, $8,000. Cash purchases, $12,000. Credit purchases $20,200. Question says, from the information above, what is the correct closing total for the sales account? A, $47,000, B, $49,000, C, $55,000, or D, $59,000. Now, we know, it says sales account. So let's look at what is connected to our sales account. Cash sales, yes, and credit sales. So in drawing up our T account, we know we would debit cash and credit sales $10,000, right? Credit sales, we would credit, it would be on the credit side in our sales account. Good. So cash and credit $10,000 and $45,000. That's a total of $55,000. So our answer would be C. Let's go on to number 16. It says, which of the following entries would not appear in a cash book? A, payment for goods $100. B, goods sold on credit $100. C, goods sold for check $100. And D, goods bought for cash $100. You know our answer would be B, goods sold on credit $100. That would not appear in a cash book. Let's go on to number 17. Here it says, K-Can, a debtor of A&B Enterprises, settles his debt of $120 less discount by check. How should the double entry be recorded in the books of A and B Enterprise? Our answer options: A, debit K-Can, $117, debit discount received $3, and credit bank $120. Credit bank $120. B, debit K-Can $117, debit discount allowed $3, credit bank $120. C, debit bank $117, debit discount allowed $3, credit K-Can $120. Or D, debit bank $117, credit discount received $3, credit K-Can $120. We know our answer would be C. We are going to debit bank $117, debit discount allowed $3, and credit K-Can $120. Let's go on to number 18. It says, Mr. A. Jones paid $250 in cash for repairs to machinery. This transaction was entered in the cash book and posted to the ledger. The double entry involved would be A, debit cash account, credit repairs account, B, debit cash account, credit machinery account, C, debit repairs account, credit cash account, or D, debit A. Jones account and credit cash account. We know we would, and our answer would be C, debit repairs account and credit cash account. Let's go on to number 19. Here it says, in order to avoid writing numerous checks for small amounts, a firm may set up A, bank draft, B, petty cash fund, C, general journal, or D, bank standing order. We know it would be a firm may set up a petty cash fund instead of writing numerous amount of checks. Let's move on to 20. Item 20 refers to the following information from the sales book of Arlo's 2019. We have the 2nd of January, H. Rick, 30 at $1.50, which is $45, less 33 and a third percent, or trade discount is $15. When you take that from the total of $45, we're left with $30. All right. So the question says, how would R. Lewis record this information in his ledger? A. Debit H. Rick's account $45. Credit sales account $45. B. Debit H. Rick's account $30. Credit sales day book $30. C. Debit H. Rick's account $45. Credit sales account $30. Or D. Debit H. Rick's account $30. Credit sales account $30. We know our answer would be D. Debit H. Rick's account $30 and credit sales account $30. So let's go on to number 21. It says, a businessman bought a new computer for $6,000. He paid $4,000 in cash and traded in his old computer. What is the entry to record this transaction? Is it A, debit old computer $2,000, debit cash $4,000, credit new computer $6,000? B, debit new computer $4,000, debit cash $2,000, credit old computer $6,000. Debit old computer, credit, that would be credited $6,000. Debit cash $4,000. Credit new computer $2,000. That would be in the debit side of transaction. D, debit new computer $6,000. Credit old computer $2,000. Credit cash $4,000. So we know that our answer would be, we would debit our new computer, and so would the old computer, credit old computer $2,000 and credit cash $4,000. So our answer options would be D. Let's move on to number 22. When a proprietor withdraws cash or other assets from a business, what effect does it have on drawings or capital? A, capital is increased. B, capital is decreased. C, drawings are decreased. D, neither drawings nor capital is affected. We know it is B, capital is decreased. That's our answer, B. Let's go on to number 23. Here it says, we have a financial balance sheet. Items 23 to 25 refers to the following: statement of financial position or balance sheet. Leasehold premises, $10,000, furniture fitting and equipment, $4,500. We have inventory, $2,500, receivables, $3,700, bank accrued account, $2,100, cash in hand, $500. And that is a total of $8,800. All right. When we add that to our fixed assets, we get $23,300. We have capital at start, $24,000. We have less loss per year, $2,200. When we take that away, we have $21,800. Less drawings, $1,800, $20,000. We have creditors, $2,100. Accrued expenses, $1,200. And that is total of $3,300. And when we add that, we get $23,300. So now, let's look at question 23. it says, what is the total value of the fixed assets? A, 11,200, B, 14,500, C, $20,000, D, 23,300. Well, our fixed assets are leasehold premises, 10,000, furniture, fittings and equipment, 4,500. So when we add that together, here we have 14,500. So that's our answer. So our answer would be B. So that is our answer, B. 24 now. It says, let's move on to number 24. It says the closing capital is A, $20,000, B, $20,700, C, $21,800, D, $22,800. So how do we arrive at this? Now, what is our closing capital? Now, our closing capital, we would subtract, our closing capital. I'm going ahead. So our closing capital is right here, $20,000. So our answer would be A. A would be our answer. Let's move on to 25. That's what I was working on, the working capital. It says the working capital is A, 2,600, B, 5,500, C, $6,200, D, $6,800. So we know that our current assets is subtracted from our current liabilities. So what do we have here? What's our current assets? 5,800. Let's go back. We have 5,800. Here we have it. I said 5,800. Sorry. 8,800. Here we have it. 8,800. And our current liabilities is 3,300, which is our creditors and accrued expenses. So our current assets, $8,800, and our current liabilities, 3,300. When we take away 3,300 from 8,800, we're left with, for our working capital, we're left with 5,500. So B, current assets from current liabilities. Let's move on to 26. In calculating the gross profit percentage, gross profit should be divided by A, cost of goods sold, B, net purchases, C, net profit, D, net sales. So we know that it is D, net sales. It should be divided by our net sales. Let's move on to number 27. Here it says, item 27 refers to the following information. We have an insurance account where we have our T account, debit and credit. So on our debit side, we have 2017 is a year. The 2nd of January, balance brought forward was $700. 15th of January, bank, $8,000. That gave us a total of 8,700. And then on our credit side, we have 31st of December, profit and loss account, 8,100. 31st of December, balance carried down $600. And that balance of our account of 8,700. What is the amount of insurance prepaid at the end of the year? A, $600, B, $700, C, $8,000, or D, 8,100. So our insurance prepaid is right here, $600. So our answer is A. Let's go on to 28. Which of the following financial documents shows the net earnings of a business? A. Income statement. B. Appropriation account. C. Statement of financial position. D. Receipts and payments accounts. So we know that it is our financial documents. It have to be a income statement. Item 29 refers to the following table. We have period of debt, amount of accounts receivable, provisions for bad debts. Over 3 years, accounts receivable $6,000, provision for bad debts was 3% of accounts receivable. Over 2 years, $4,000, 2% of discount received. And then over 1 year, we had 8,000 accounts receivable and provision for bad debts, we have 1% of accounts receivable. 29 says, what is the total provision for doubtful debts? Well, is it A, $180, B, $340, C, $400, or D, $500? Well, we find 3% of $6,000. Then we find 2% of $4,000, and then we find 1% of $8,000. So when we find 3% of $6,000, we get $180. 2% of $4,000, we got $80. And 1% of $8,000, we got $80. So when we add 180, because it asks for a total, so we add $180 plus $80 plus $80, we get $340. So our answer is B. Go on to number 30. It says, an asset purchased for $1,000 is depreciated at the rate of 10% per annum using the reducing balance method. What is the book value of the asset at the beginning of the third year? A, $800, B, $810, C, $900, D, $1,110. Now, we know that 10% of $1,000 for year one, 10% of 1,000, we get $100. When we subtract $100 from $1,000, we get $900. That's year one. Year two, we find 10% of $900, we got $90. And year three, we would subtract $90 from $900, and we got $810. So year three, that would be our answer, $810. B. Let's go on to 31. It says, an increase in the provision for doubtful debts will be A, added to sales in the trading account, B, subtracted from sales in the trading account, C, included as revenue in the profit and loss account, D, included as an expense in the profit and loss account. So it says an increase in the provision for doubtful debts. So we know that it would be D, included as an expense in the profit and loss account. So that would be our answer. D. Let's go on to number 32 now. Item 32 refers to the following table, which shows the summarized position of Foster and Scott Limited at 6th of March 2019. We have current liabilities $60,000, current assets $100,000, non-current assets $200,000, and non-current liabilities $150,000. The question says, what was the capital of Foster and Scott Limited at 6th of March 2018? A, $40,000, B, $90,000, C, $150,000, or D, $190,000. So when we add, we know that our capital is equal to our assets minus liabilities. So what's our current assets? Current assets, we have $100,000 plus non-current assets, that's $200,000. So we have $300,000. Our current liabilities, $60,000 plus $150,000. That's $210,000. So we have, when we subtract, we had $300,000, subtract $210,000, we get $90,000. So our answer would be B. 32 would be B. Let's move on to 33. Item 33 refers to the following information. On the 1st of January 2019, $10,000 was paid towards an advertising campaign. Of this amount, $7,000 was used by 31st of December 2019. What was the amount of advertising prepaid at year's end? A, $3,000, B, $7,000, C, $10,000, or D, $17,000. So we know that we would subtract $7,000 from our $10,000. We're left with $3,000. So our answer would be A. That's the amount prepaid at the end of the year. 34 says, a standing order of $25 for insurance appears in the debit column of the bank statement. This amount does not appear in the cash book. How is this item treated in order to update the cash book? A, credit the bank account with $25. B, debit the bank account with $25. C, add $25 to the bank statement balance. Or D, subtract $25 from the bank statement balance. We know it would be credit the bank account with $25. That would be your answer. Go on to 35. Item 35 refers to the following information provided by a business. Total unpresented checks, $120. Lodgement not entered on bank statement, $150. Balance per cash book, $560. What is the balance per bank statement? Is it A, $120, B, $150, C, $340, or D, $530? So our bank reconciliation statement. So we have balances per cash book, we have $560. Then we are going to add unpresented checks, which is $120. So when we had 560 and 120, we get $680. Then we're going to less bank lodgement not on bank statement, not entered on bank statement, $150. So when we take away that 150 from 680, we're left with $530. So our answer would be D. Let's go on to number 36 now. Item 36 refers to the following information. Inventory at 1st of January 2019, $1,500. Purchases during the month, $1,200. Cost of goods sold, $1,400. What is the inventory at the end of January? A, $300. B, $500. C, $700. D, $1,300. So we have our opening stock there, $1,500. Inventory at 1st of January 2019. Then we're going to add our purchases during the month, $1,200. So we get $2,700. And then usually we would less our closing stock, but that's what we are yet to find out. Now it says cost of goods sold is $1,400. So for us to get that, we would have to take away $1,400 from 2,700. So the inventory or closing stock at the end of January would be D, $1,300. Let's go on to number 37. It says Mrs. Allen invested $20,000 and Mrs. Brown and Mr. Cable invested $5,000 each into the same business. The loss sustained during the year was $1,000. The partnership agreement is silent on the item of losses, although profits are to be split in the ratio 2 to 2 to 1 in favor of Allen, Brown, and Cable respectively. How much of the loss must be borne by Mr. Cable? A, $140, B, $200, C, $300, or D, $400. Now we are told that the ratio that Mr. Cable got was 1. So we would have to find our ratio. We add 2 plus 2 plus 1. So out of 5 parts, he got 1/5. So we have to find 1/5. And notice the question says how much of the loss. So it says the loss sustained during the year was $1,000. So we would therefore have to find 1/5 of $1,000. And when we find 1/5 of $1,000, we got $200. So our answer is B. Let's go on to 38. It says Mr. Green and Mrs. Black agreed to establish a partnership, Green and Black Company, and each of them deposit $5,000 into a bank account. How should this be recorded in the books of the partnership? A. Credit, cash $10,000, debit capital $10,000. B. Debit Green and Black Company $10,000, credit bank $10,000 each. C. Debit partnership bank account $10,000, credit partners current account $5,000 cash. D. Debit partnership bank account $10,000, credit partners capital accounts $5,000. So what would be our answer then there? So looking at an option A, we know that couldn't be credit cash, $10,000 debit. No, it would not be B either. So neither C. Our answer is D. We would debit partnership bank account $10,000 and credit partners capital accounts $5,000. So based on the question, so we would debit partnership bank account $10,000, both of them, and then credit the partners, each of them that started it with $5,000. Let's move on to 39. A trader had an opening capital of $3,900. If his drawings were $900 and his closing capital was $4,860, what was the net profit? A, $900, B, $960, C, $1,860, D, $3,000. So what? How do we know? How would we arrive at our answer? Well, it says net profit. So what we would do, our opening capital $3,900, we would less our drawings from that, which is $900. So our net profit would be $3,000. So our answer would be D. Let's move on to number 40. It says, Rose contributed $7,000 in cash and a motor vehicle worth $3,000 to a partnership. Rose's contribution to the partnership would be recorded in the journal as we have our debit and credit column. A, cash debit $10,000, Rose's capital credit $10,000. B, Rose's capital debit that $7,000 and credit cash $7,000. C, cash debit cash $7,000, debit motor vehicle $3,000, credit Rose's capital. Or D, debit Rose's capital $10,000, credit motor vehicle $3,000, or credit cash $7,000. We know our answer would be C. We're gonna debit cash and motor vehicle and credit Rose's capital. So we have come to the end of part 1. Please remember to like, share, and subscribe to the channel and stay tuned for part 2.